Bank of America reporting a beat on the top and bottom lines today, driven in part by a 25% rise in net interest income and better than expected sales and trading revenue. Our Becky Quick joins us now for an exclusive interview with Bank of America Chairman and CEO Brian Moynihan. Becky, over to you.
Scott, thank you so much. And I want to welcome Brian Moynihan. Brian, earnings very strong across the board. Scott just mentioned a lot of the numbers. I think it was the net interest income that had so many people kind of watching and wondering what happens next. Those numbers are strong. It means that you can get deposits paying out very low amounts of interest to people, but you give out loans at higher rates. What are you seeing just as we get deeper into this towards the end of the quarter as things change so much with banking? Is the net interest income, is that a number you think can continue, or how do things change and how they shape?
Well, at the end of the day, it's good to talk to you again, Becky, and thank you. The team at Bank of America had a great quarter, $8 billion plus in earnings and 17% return on tangible common equity, and we did it by growing loans year over year and having deposits stabilize. As the Fed is withdrawing monetary accommodation, QT, shrinking their balance sheet, everything your colleagues were talking about before, the money's got moved to off the bank balance sheets out of the system, but our deposits held up relatively well. And I think even through in March, even through the changes of March in the banking system, our deposits held up well and performed a little bit better than we thought we did. So we had $14.6 billion in NII for the quarter, up 25%, as you said. But the real question is, what do? We open accounts for people and they give us deposits, and then we turn around and make loans to people, or we invest the excess, and that's been going on for years. It's called banking, and then we have fee revenue streams, and all of them performed well linked quarter, albeit that the pace of rate rises has slowed, so therefore you're starting to see NII flatten out, and it was down a little bit quarter. The core banking book more or less flat, and we see that continuing in the future, and we gave some guidance today they'd be down a little bit next quarter, but we feel pretty good about it.
You said today that you're anticipating a mild recession at this point, just based on what you're seeing with the consumer, which still looks strong, maybe a little bit of a slowdown when it comes to commercial issues, commercial loans. But is that dependent on the Fed slowing things down after this next rate hike that's anticipated?
Well, we base our earnings on the market, and the market has one Fed increase left in a forward curve and then has cuts. Whether those come true or not is really going to be dependent on what the Fed sees at each meeting, because they're completely driven by trying to figure out what's going on in data. Our team, Candace Browning-Platt and the research team, have a recession and have consistently had a recession predicted for the second half of this year, third quarter, fourth quarter, first quarter of next year, and then ends, and we start to see positive growth. And so that's based on the Fed tightening having finally taken hold, and those experts see that. When we look at our consumers, though, you can see the core conundrum that faces the Fed. Our consumers spent 9% more in March of 2023 than they did in March of 2022. They spent about 8% in the first quarter more than they spent last year in the first quarter. And they're spending on things, frankly, which drive employment, and meaning they're spending on experiences at amusement parks or theaters or restaurants or outside concerts or outside entertainment. All these things drive people to make them happen, as opposed to other things, buying a product which would come from another country potentially. So U.S. employment is very strong. So our customers are seeing wage growth and seeing wages, and they also have money in their accounts, still a lot of stimulus money left in. So that's what the Fed is trying to slow down. And albeit I think we see, and our experts see, them having a mild recession, which if they could do that and unemployment never got much above 4.5, that would be a heck of an accomplishment. And so that's the base case, and we are running the company accordingly.
Deposits were down just slightly, but you're still talking about deposits up over $500 billion from what they were pre-pandemic at the end of 2019 or going through that. You and I have talked a lot in the past about deposits being sticky. Are they still going to be sticky? Because one thing we've learned during the issues the banks have been having recently is that people are willing and able to move their money pretty quickly electronically.
Yeah, I think if you look across our customer base, deposits is a great big word, and there's 1.91 trillion of them at Bank of America, and it is up $500 billion or more since pre-pandemic. And you'd say, well, is that going to go back out? And the answer is the economy on a gross basis is up a lot also. So the industry's deposits are up 31%, ours are up 34%. We have gained share during the pandemic and this aftermath, and that's by opening up. Since the pandemic started, we've opened up 2.5 million net new checking accounts in our consumer business. Our wealth management customers have opened up 25,000 or so bank accounts last quarter, the first quarter this year. We just keep deepening our relationships and driving it. That means our deposits are inherently sticky because different customers are using the cash for different purposes. If you're a core general consumer in our consumer business, your money's coming in and out of your household, you're paying your bills, et cetera. If you're a wealthy customer, when cash funds were basically getting zero and there was nothing to do with the money, you just left it sitting at the bank. When a money market yields or direct treasuries went up, you moved some out. We expected that to happen. As a matter of fact, we did it for the customers. That's the way it works. And then when your corporate customers, the same thing, and there's even some tedious stuff that in there called earnings credit rate and things like that. But basically, companies pay us for their services by leaving deposits with us. If we raise that rate, they can leave less deposits. Now, interesting, those deposits have been relatively stable the last 6 months. So each customer base, who it is, what they do with the money, investment cash versus transactional cash is very different. But at the end of the day, $1.91 trillion of deposits. They've been relatively stable the last 6 months. We showed some detail to that. And we feel very good about that. Given those deposits, we make loans and serve our customers that way.